What I would say, having worked in Brussels in 92 to 98, I saw the crisis in the currency and the exchange rate mechanism and then the creation of the single currency. So it's wise not to write things off. The second observation I have is that clearly the first architecture, first forms and structures were flawed, and they were exposed as such in the global financial crisis. But on the other hand, we've had a tremendous amount of new institution building, crisis management go on. And from our perspective at the Financial Times, it looks as though the existential threat to monetary union, where people really thought it could break up in 2009-10, seems to have receded, and there are even some signs of a recovery. However, if the monetary union is not in an acute crisis, we're still in a chronic phase, and many issues remain to be resolved. And so we're so fortunate this morning to have a group of experts, not just experts from the International Monetary Fund, but also actors, that is to say central bank governors and finance ministers. So it is my great pleasure to introduce the panel and ask them to make brief opening statements. And then we will have a discussion on the panel and open it up, because we're very democratic here, to the floor for questions. So the first speaker is Dr. Erik Berglof, who is the chief economist at the European Bank for Reconstruction and Development. Erik, the floor is yours.
Thank you, Lionel. So this panel is about the economic and monetary union. I'm always very cautious when I comment on the monetary union. As a Swede living in the UK and with my heart in Eastern Europe, I'm always a bit cautious. So I think it's fair to say that, of course, the ultimate decisions about how to design the monetary union should be decided by the policymakers and ultimately by the citizens of the monetary union. But I think we know now that those decisions have implications beyond the monetary union. It has implications for other EU members. It has implications for countries that are in the sort of immediate hinterland of the EU, countries that are aspiring to join both the EU and the monetary union. And I think you can also argue that these decisions have implications much beyond that. So I will come back to that very briefly at the end. So as Lionel said, of course, we've had some recently some good news on the health of the Eurozone. I mean, this is all relative because we haven't been very spoiled with such news lately. And on top of that, there is, so on top of the signs of growth, there are some hope that the most radical, the most extreme downside scenarios have become less likely and maybe also, even so, less severe. But the crisis is not over in any sense, and there are some pretty dark clouds hovering over the horizon, and I'm sure that the determination and imagination of European policymakers have not been fully tested yet. So where is the Union today? It's easy to criticize European policymakers for dragging their feet, for behaving in a sort of haphazardly opportune way. But as Linus was stressing, I think no one would have expected a year and a half ago that we would be where we are today. We have a banking union, the first elements of a banking union underway. We have a single supervisory mechanism. We have at least the embryo of a resolution arrangement. We have the elements of a fiscal backstop. That was unthinkable, I think, a year and a half ago. So we have made some progress. But there is still a number of parts to the puzzle that needs to be put in place before the banking union can function as it is intended. We need a common deposit insurance. We need to strengthen both the national deposit insurance systems, but we also need to get something at the European level. I think that is, unfortunately, it seems quite far away. And for that, we need also elements of a fiscal union. I happen to think that we don't need a lot, but we need some, and we need to recognize that this is a common fiscal obligation. I think there one should argue also that we have seen a lot of sort of ex post fiscal transfers. So very large sums of money have gone across borders in Europe to support countries in trouble. I think had we had in place this banking union in all its pieces, those costs would have been much lower. So we need some fiscal union, but we don't need a lot, I think. And of course, then there are many other parts of the fiscal union that may be needed for other reasons, but to get financial stability and get the banking union to work, we don't need that much. So let me just come back now finally to this outsider perspective, because we know that there are these countries that are outside the European Monetary Union that are now facing this decision whether to opt in or not. And there are those countries that are outside the European Union and would like to join, and then there are the others. And I think what we need to remember here, we cannot create a monetary union that creates new barriers in Europe, and particularly in this part of the world where so much still hinges on this possibility to join the European Union. So we need to, and I think there we have made a lot of progress in offering something to these countries that want to opt in. I think there it's almost in place. We now need to focus on providing mechanism arrangements that can support those countries that are in the process of joining the European Union. And there, I think there are a lot of ideas. It's about sharing some of the fiscal backstop. It's about providing swap lines that can help countries through difficult periods. It's about exchanging supervision and information. I think this is absolutely critical. So we are not through this crisis yet. We need to take into account the consequences of the decision we're taking to resolve the crisis, the consequences for outsiders as well. We've had some very good news over the last year. We've had Croatia joining the European Union. We have Latvia being given the clear light. I think there is still a lot of that soft power left for the European Union and for the European Monetary Union to have. So on that note, I hand the floor over to Lionel again.
Thank you, Eric. And congratulations for managing to talk about monetary union for 4 minutes without mentioning Germany once. But we'll come back to that. You also made some very important points about the key banking union and how that will fit into the new architecture, and we will come back to that. But I'd now like to turn to the second speaker, Dr. Uroš Kufa, who is the Minister of Finance of the Republic of Slovenia.
Thank you very much. We are not going to abolish euro today, right? I got used to it and I tend to like it. The euro coins and banknotes are quite convenient, so whenever we travel around Europe, we can use the same currency. That's really great. What I notice is that euro has changed a policy debate quite a lot as well. Imagine how the debate would look today if we wouldn't have a euro, but we would have a local currency. We would discuss how much we should depreciate the currency, what would be the sustainable level of inflation, what kind of adjustment we can do in the monetary policy side, and we would focus much less on the real economy. And if you look euro as an instrument of monetary policy, I think we should take a look whether euro really did cope with all the challenges that we have. We are still facing inside the Europe a huge flow of capitals within the Europe, not that much outward of the Europe, and I think this is something that we need to look further on and make some improvements in this area. Thanks.
Thank you for being so brief. We will be asking some questions about Slovenia's record inside the Union, but I think with the central bank governor here, we'll listen to him. But thank you, sir. The next speaker offers a very important perspective, an impartial perspective from the IMF. It's Mr. Philip Gerson, who is the Deputy Director of the European Department at the IMF in Washington. Thanks.
Thanks very much. It's a pleasure to be here this morning, really, in this magical setting of BLED. I want to, because the topic is the future of monetary union, I'm going to focus on challenges for the medium and longer term, not on the short-term challenges or the immediate challenges. But I still think it's important to talk about the challenges that Europe faces right now in terms of faster growth in order to give a setting for what's going to emerge as the medium-term priorities. And I think there are three things that I would point to as immediate challenges for restarting growth in Europe. They're financial fragmentation that inhibits the effectiveness of monetary policy and prevents the flow of financing to the periphery. There's the still large debt overhang, public and private, in a number of countries in Europe that's requiring simultaneous deleveraging, that's slowing domestic demand growth. And finally, there's the well-known structural impediments in labor markets and in product markets that are constraining potential growth, not just in the periphery, but also in the core. Now, dealing with financial fragmentation is going to require cleaning up bank balance sheets, but beyond that, it's going to require continued progress on the path to banking union that Eric has already talked about. There's the single supervisory mechanism that's needed for a systematic approach to bank supervision to prevent ring fencing at the national level. And there's also the single regulatory mechanism to help break bank sovereign links and also to prevent deadlocks that might emerge in resolution of cross-border cases. And the common financing mechanism for the single resolution mechanism is one step towards fiscal union, but more needs to be done over the medium and longer term. And I hear it's worth pointing out, I think, that it's well known that a stronger fiscal union could help deal with asymmetric fiscal shocks. But probably what's less well known or less well recognized is the role that fiscal union can play in addressing the risks that come from asymmetric fiscal policies. And I think if you look at what's gone on in a number of countries in the euro area since the start of the crisis, it's clear that asymmetric policies in the period leading up to the crisis had a lot to do with the difficulties that those countries are still facing. I won't spend a lot of time dwelling on the structural reform agenda because I think it's pretty well known. Labor market reforms are needed to address dualism in labor markets and to create labor markets where wages can respond more flexibly so that when companies face shocks, they can respond to them. There's a need for targeted implementation of the Services Directive to encourage competition in protected areas, to allow cross-border competition in services. There's the standard stuff about reducing regulatory barriers to entry and exit to allow greater competition, tax reform to help unleash the power of the corporate sector. All these things, again, are well known. Now, reforms in all of these areas, greater progress towards banking union, towards fiscal reform, structural reform agenda, they're all going to require transfers of sovereignty from national governments to the center. And I think it's an open question whether or not national governments going forward and citizenries of those countries going forward are going to be comfortable with ceding some of that sovereignty to the center. And, Eric said, as a Swede living in the UK, he has a bit of trepidation in talking about the euro area. Well, imagine what it's like for an American who lives in Washington. But with that, let me say, because it's fashionable, I think, to have skepticism or even outright pessimism about the prospect for this, let me talk about some reasons why there might be some optimism going forward. And one thing that I would point to is that there's already been a substantial amount of collective action at the euro area level over the last couple of years to work towards a resolution of the crisis. And to put some specifics to that, I would talk about the development of the OMT framework, about the development of the framework for the ESM, about the improvement in fiscal frameworks via the two-pack and the six-pack and the other packs, and about the extension of maturity on loans to program cases. These are all cases where the euro area got together at a collective level and made reforms that help cement the future of the fiscal union, or of the monetary union. So I think amid all the skepticism and all the pessimism, I do think there's grounds for some optimism going forward about the future of the euro area.
Thank you very much. Our next speaker is Mr. Boštjan Jazbec, Governor of the Bank of Slovenia. And just forgive me if I didn't quite pronounce your name correctly.
should rather say that I should not say anything about the euro area, because otherwise I'll sit alone at the separate table at the meeting on Thursday at the ECB Governing Council, and it's exactly for the same reasons as Eric and Philip cannot talk about freely about the euro area because they are geographically not there. Slovenia is geographically there, but we are still not allowed to freely talk about what we think about the euro area and Eurozone. Especially in a sense of the outsider, somebody might thought of euro area and Eurozone as a nice parlor game with rather dynamic and sometimes elusive rules, and especially in the case of a crisis, where those rules are determined indeterminately, and then they sometimes pose problems for the countries, and then for the member countries especially, in a case when they should count on the rules. And this is something that in my view, is a process that we are currently in, because the optimum currency area that was the aim or the fundamental start of the whole talks about the euro area is something that we still do not experience, and something which might be our final aim in getting there with all the necessary or sometimes unnecessary corrections to the mechanism which Eric mentioned. It's a banking union. It's a step forward, which I believe that and I hope that in the very near future will provide the basis for rather more efficient and more stable financial systems. It's because I'm rather new kid on the block. It's my mandate is just a little bit more than a month, and I could still feel the freshness of going to the office every single day. I still have problems of getting all these internal dynamics in euro area right. Why? Because in the case of Slovenia, and I hope that we should also touch the Slovenian case, we are definitely benefiting from being in the euro area, though the requirements and the steps that we had to fulfill were rather stringent, and then those stringency of the steps also prevents any further enlargement of the euro area. And in some cases, this might work counterproductive. Why? Because the region, and Slovenia as part of the region, they're all small open economies which cannot run independent monetary policies. And monetary policy, or in this respect the exchange rate, which is nothing but adoption of euro in some respect, is just n-1th equation in a system of macroeconomic equations, which sometimes may or might work right, but most often does not. And for that reason, I still think and still believe that euro area as a parlor game where we should all work the definite rules which might prevent the latest crisis or any further crisis, because we all know that the crises continuously appear and reappear. And in this respect also, we should every time look around and believe that we are not the only one being in a crisis. And this is especially difficult in Slovenia, where, listening to and reading only Slovenian media, some might have a feeling that financial crisis is happening only in Slovenia. And for that reason, the rules of the games of the euro area and then the Eurozone in particular are something that we should clearly understand and work for the common benefits. This is also something which in some countries, and you go to the latest crisis areas in Eurozone, where all the representatives of the IMF, European Commission, European Central Bank are not really very welcome. And this is something that we should change and turn around and make those international organizations a partner in solving these problems, and especially in clearly defining the rules that we all try to play game with. Thank you.
Thank you very much for that perspective from the new kid on the block. I've only been here 24 hours, and I must say I've been very struck talking to some of the media here in Slovenia that there is that view that the crisis is only happening here, and the fact is if you go elsewhere in Europe, believe me, you can taste it, smell it, and it really feels like there's a serious problem here. The one thing, of course, is that Slovenia, in a way, is a guinea pig because you're having your bank tests done this year, whereas the hard medicine is going to be taken next year, and that could be a very important...
Did you say that, or I said that?
No, I was just... no, you said that without your lips moving. We'll come back to that, too. Anyway, the next speaker is Dr. Miroslav Lajčák, who is the Deputy Prime Minister and Minister for Foreign European Affairs of the Slovak Republic. Thank you.
I think I'm the first speaker at this panel who is not a financial expert or a banker, so I'll try to offer a slightly different perspective of someone who has been part of the processes taking place at the political level, at the European level. And the fact is that we are in a different place. When we discussed the situation in the Eurozone here in Bled last year, the media were full of speculations and markets were full of mistrust and our people were full of uncertainty. So this is all gone. No one speaks about the end of Euro. No one speaks about the departure of this or that country from the Eurozone. We have moved from the operational crisis management into a stage where we are searching for systemic solutions. And we have hard facts, evidence to be more optimistic. First, the cumulated budget deficit of the Eurozone went down from 6.4% in 2009 to 3.7% last year, and it's going to be below 3% this year. The government bonds in Portugal or in Spain, of course, have their interest rate dropped by 50%. And we will be seeing, the Eurozone emerged from the crisis, from the recession, for the first time after 18 months in the second quarter of this year. So we will be seeing new elements such as the European Commission scrutinizing the national budget proposals of the EU member states. So this is unprecedented and unheard of. So we are definitely in the better place, but of course there is no time for complacency. On the contrary, there are a couple of elements I believe we shall focus on. First one, to keep the confidence of financial markets by thoroughly implementing what has been already agreed, and second, by continuing to implement and to bring about what has been called the economic and monetary union, because we are only partially in the process of implementing the banking union, and we are still speaking about the financial and economic union. So this must continue. My point number two is, of course, to keep our public, our citizens on board. They must understand what we do and why we do what we do. Otherwise, even the perfect solutions will not work. Point number three is the political sustainability of the new model, namely the division of competencies and responsibilities between the national level and European level. So when we transfer, and we do speak about transfer of competencies, but it must be accompanied by the transfer of responsibilities. It's, from my perspective as a politician, member of national government, it's not acceptable that the European level makes decisions and we take the political risk of implementing this without being part of this decision. So there must be clarity about who makes these decisions and who bears responsibility. And my last point is about the future architecture of the European Union, because we are clearly moving towards deeper integration, greater integration. We are changing the architecture because we are getting more and more into the multi-speed Europe. We are different level of European integrations. We are more and less enthusiastic countries participating in this process. So there are a couple of elements to look at. First of all, to keep it open and flexible, to avoid the risk of turning European Union into a train that has the first-class coaches and second-class coaches forever. So those who are currently out but may wish to get in later on must have the chance. At the same time, those who decided to stay out must not have the power to block those who want to go further and deeper. And the European integration must not be a la carte process or cherry picking. So it really goes with all the responsibilities. These are all the elements and challenges we will have to deal with in coming weeks and months. But in general, I'm optimistic because we have situation clearly in our hands. We have identified the challenges. What we need is to show leadership and responsibility and also the courage. This is how I see the situation.
Well, thank you very much. That train analogy is utterly irresistible because, as you say, the first class, those in the first class, they're in and they want to go deeper with some disagreements perhaps in certain areas, but the second class, which I gather Slovakia is in, countries... Oh, are you in the third class with Britain?
No. I was in one panel recently, and one of the panelists, which was not me, spoke about the group that is called Wider Germany, that consists of Germany, Finland, Netherlands, and Slovakia, which are the most strict countries when we speak about the need to respect the rules and play well, and also doing your own homework. For us, for Slovakia, there is absolutely no dilemma. Whatever the future architecture, we have to stay at the core group of the European Union.
Okay, we'll be talking to Dr. Stubb here about being a member of Wider Germany in just a few minutes. But before we do that, we have to go to Mr. Carlos Moedas, who is the Secretary of State to the Prime Minister of Portugal, which on a personal note, I would stress, has probably alongside Ireland been probably one of the countries that has taken some of the most difficult measures to rein in the budget deficit and take structural economic reforms, and is still not out of the woods. But perhaps you could elaborate on that. Thank you.
Thank you very much, Lionel. Thank you very much for having me here today and having the opportunity of telling you a little bit about what I think about Europe and what we've been doing in Portugal about the adjustment program and how it fits in the whole story. I think that sometimes we do really focus on what's gone wrong in Europe and the flaws of the European project and not on its actually the good things about Europe. And when you think about it in the long-term perspective and you look at Europe as a continent that has been, as Indermit Gill at the World Bank says, a convergence machine. Portugal is an example of that. A lot of countries are an example that they got into this machine and their people living standards have increased during the years. Second, Europe has been and will be an innovation platform. I mean, we have here Alex Stubb that can tell you a little bit, and I'm sure he's very keen on the innovation part of the story of Europe, where you have 1/3 of the world GDP is Europe, with less than 1/10 of the population. And third, and more importantly, is Europe as a platform of social protection. I mean, we have a model in Europe that is looked as a great model of social protection at a cost. And so we have to do everything to maintain this model. And that's why we're doing the sacrifices we've been doing in Portugal, to be able to be part of this club. And to be part of this club is to respect the rules of the club to start with. And so when we look at the past 10, 15 years in Portugal, what we see is actually a case study, because you have had a country that actually had deficits after deficits and basically had absolutely no growth. Portugal, after the year 2000, if you look at the span from 2000 to 2011, Portugal grew less than the United States during the Great Depression and Japan during the last decade. So spending does not create growth. So the first step is how can you actually consolidate? How can you actually live within your means? And that's a big part of the job that we've been doing in Portugal. The second point, and more importantly, is when colleagues of mine around Europe ask me, but what do you really need from us? And I normally say, I just need Europe to do the same structural reforms we've been doing and struggling in Portugal. Why? Because if you don't do it, that creates negative externalities to my country. Because I've been doing these reforms that Philip was talking about the labor market, finishing with the dualism of that labor market, on the product market, on the tax side. And so, if you have one country doing it, you need all the other countries doing the same. And so the game today, and it's actually how you actually look at these negative externalities around Europe and be able to ask other countries to go through the same path. Because if you want to be in this union today, and if you want this monetary union to work, this is about these structural reforms. The point of the structural reforms that I normally use to describe is that it's very difficult to explain structural reforms. It's difficult to explain it to your people. It's difficult to explain it in a forum because the span of attention normally today is very quick, and you cannot explain structural reforms on 140 characters of Twitter. You have to explain it in a much deeper way, and those structural reforms are the key for the success of the future of Europe. You want it or not, that's the major point. We can have discussions about the monetary union and all the tools. We can have discussions about how Europe will work, but without being able to do it, you're not gonna be able to have a future for your children, and that's part of the game. So that will be my message to start with. Thank you, Noel.
Thank you very much indeed. The next speaker is Mr. Alexander Stubb, Minister of Foreign Affairs and Foreign Trade for Finland, and a long-time Brussels watcher.
Thanks a lot, Lionel. I can't resist starting with a skiing anecdote because I'm married to a Brit, and I always tell her that, Suzanne, don't worry, you ski really well, but I do add after that, for a Brit. But you can say the same thing about me and cricket, I think, and I see from your Twitter account that you're very good at cricket. And may I just start by saying that I agree with most of what Carlos just said. I only disagree on one point. I think you can explain a lot in 140 characters on Twitter. What I'd like to do is very briefly in 3 minutes basically try to make 3 points. The first one is on general state of play. I fully agree with Lionel when he said that, look back 2 years. And then we had an existential crisis about the euro. We didn't know whether the currency was going to survive. You remember all of those cynical columnists, such as Paul Krugman or Münchau and others who said the euro is going to collapse. That's it. That was the general mood, and people were actually quite scared. A year ago, we had reached a better phase. Then we only talked about Grexit. Some people talked about fix-it. So individual countries exiting the euro. Now look, no one is talking about that now. Everyone is talking about, okay, who is going to come in next? So I think the biggest systemic problems which have been highlighted by the panelists have in many ways been taken care of. And that's where we come to, I guess, my point number 2. What should the focus be on right now? I think the focus should be quite simply on growth. And I don't think that there are any shortcuts on this. And I equally think, as a liberal economist, I guess, that it's not going to be EU-driven, nor is it going to be nationally driven. It's going to be driven by competition, and competition is created by companies, by entrepreneurs, by enterprises, and by workers. We can only create the conditions. And I think we need to do 3 things. Number 1, we need to do structural reforms at home. Look at the so-called program countries, Portugal, Greece, and Ireland. They are the guys who are showing the best signals right now in terms of industrial output, in terms of slow growth going, in terms of trying to balance their public finances. Why? Because they did the tough austerity programs a few years back. It's us, the likes of Finland, that need to do our homework now to sustain our AAA stable rating. And that's what we're trying to do basically with an internal devaluation in Finland last week. So number 1 is structural change. Number 2, and I think this was mentioned by Philip, we need to continue the liberalization of the internal market. I mean, for goodness sakes, the European Union is about free movement of goods, services, money, and labor. But what we're doing right now is we're stifling those freedoms with too much regulation, with too much red tape, and too much blockage. And we need to avoid that. We need to allow the European economies to grow, not to create more red tape. And this comes from someone who is a federalist and very, very pro-European. The third thing we need to do and push for, of course, is free trade globally. We have to be very careful with all of those protectionists who are trying to block the WTO, who are trying to block free trade agreements between the EU and the US, who are trying to block free trade agreements between, for instance, India and the European Union. Free trade is what we are all about, and that's what we should focus on. The final and third point I wanted to make is from a Finnish perspective. We just did some work on the Finnish currency and its history since 1862. And I think the conclusion was very simple. And here is when we come to the point about historical perspective. Ever since 1862, the Finnish currency has been extremely volatile, extremely fluctuating, and extremely linked to big power politics. It was pegged to the gold standard. It was pegged to the ruble, to the pound, to the dollar. It was all over the place. We devalued, we revalued, we took out 3 zeros, etc., etc. It was extremely unstable. Now, relatively speaking, the past 12 to 13 years of the euro has been by far the most stable period of our currency. Now, of course, you can counter-argue and say, but Alex, you haven't been able to devalue, you have lost competitiveness. Well, yeah, partially, but then we have to do the structural changes in this package. And let me say, as someone who comes from the opposite side, I guess, geographically, of Europe than Slovenia, Finland has never, ever been more influential in world politics or in financial or monetary politics than we are right now. Why? Because we're AAA rated, we're stable, and we are in the euro, and we sit around the tables where decisions are made. So I'm very optimistic about where Europe is going to go, and we're going to start on the growth path. These were my 3 points. The first one on the general situation, much better. The second one on what we need. In other words, free trade, internal market, the structural change, and thirdly, the benefits for Finland.
Thank you very much, Alex. I just wanted to try to put a little bit of context, see whether the panel agree with a basic proposition on why we are in a better state today than 2 years ago. What's changed? And does the panel agree, and anybody can jump in, maybe Eric would be best because he's not a central bank governor, so to speak, but that there was a central calculation made by the people who really mattered in Europe, that is Chancellor Merkel and Mario Draghi at the central bank, and Wolfgang Schäuble, and to agree 1 or 2 other players, that essentially the Germans decided it was more dangerous to let the monetary union break up, Greece go out, exit, and contagion, and therefore there's an essential bargain. Yes, the European Central Bank can provide an emergency backstop, that's the OMT, the outright monetary transfers transmission process, to intervene in the bond market to keep these bond yields down because they were very, very high, dangerously high 2 years ago. And in return, countries will take their medicine. They will reduce their public debt. They will introduce structural reform. And that reason that there's now an accommodation, a settlement, if you like, that's where we are. The question is, if that's true, can that essential bargain remain intact? Eric, do you want to try that, or do you disagree?
Well, you said that I didn't mention Germany once in my introductory comments. I didn't mention any other EMU member either, but I do think Germany has played an important role. For all the criticism we can have of Germany playing this out in internal politics and being, some of the less attractive side of German political life has also come to the fore in this debate. But I think Germany has, on the whole, been very constructive. I think other countries have tried to block when there was the attempt to create arrangement at the European level. So I think the basic calculation or the basic deal that you outlined, I think has been shaped to some extent by Germany, or to a considerable extent, but I think it is the right deal. Having said that, I think that we need to also look at, what is it that citizens of the Eurozone and citizens of the EU want, and my concern is that there are many parts of this project and many parts of that deal, perhaps, that citizens have not really bought into, and that's why I'm trying to push, the banking union, because I think this is some project I think can be made sense of to people. They saw what happened. Well, they see what kind of financial system we have in Europe. They saw what happened in the crisis, and there was this absolute understanding, I think, among most people that you needed some kind of framework to support that structure. And so I think we have now also elements of this European project that are quite concrete and also possible to sell to people. So as long as we can find a deal that of the type that you described, but that also has some democratic legitimacy, I think we will be fine.
We'll come back to this point about public opinion in just a minute, but perhaps one of the panelists, these experts, would just like to tell the audience in very simple terms, not using jargon like six packs, which by the way has got nothing to do with Arnold Schwarzenegger, I just want to make that clear, or ESMs or single resolution mechanisms. Just why is banking union so important for the monetary union? Why is it the necessary complement? Do you want to try that at the end? Yeah, Mike? Sorry.
Okay. I may slip into jargon, and I apologize for that if I do. But the reason that banking union is important is because if you want to have a free flow of capital across national boundaries, you need to have a mechanism that allows you to make sure that banks continue to be supervised adequately, and to make sure that when there are problems in a banking system that involve a bank that's exposed in many different countries, that you have an effective way of resolving those mechanisms, and you don't have each individual country essentially circle the wagons. I think that's jargon, but it's not banking jargon. Essentially decide on its own that it's going to settle the problems in a way that's most effective for its own national interests, but may not serve the interests of the euro area more broadly. So that means you need to have a forum where regulators can get together and talk about the issues, and you need to have a way financially of resolving any problems that draws on a pool of resources that's contributed to by everyone, rather than something where each individual country is out to try to minimize the cost that it would face in resolving the system.
And let me just ask you one other question on this. Is a common deposit guarantee system an essential part of banking union, or do you think that you could have something less than a common deposit guarantee system, which of course the Germans have serious reservations, and not just the Germans, the wider German area I think has some serious problems with. Yeah, please, everybody's jumping in now.
Can I, as part of wider Germany, I guess? I think the explanation that we just heard from Philip is the correct one. The way in which I try to see is that banking union is about two things, right? It's about resolution mechanisms, and then it's about supervision. The third,
resolution being if somebody goes bust, right?
Yeah.
Who gets the claim on the assets?
Exactly. And there we need to have the private investors involved in it. The third part of it is deposit guarantees. And I'm highly skeptical, actually, about deposit guarantees, because then you're trying to create a sentiment whereby I am depositing part of my personal money, which can then be used to solve some kind of a crisis. And I think the banks themselves can deal with this. It's not something that we need on a Europe-wide level, and it also gives me too much of an uncomfortable sense of distribution type of a union. That's not what we need. We need to have incentives for tighter controls and for better using the rules and regulations that we already have, just like Carlos said. So banking union is a necessity, but only to a certain point, says smaller Germany.
Okay, Mr. Jasper.
Just related to what Alexander just said, I this is also why the deposit insurance scheme is third in a row to get. So whether we get there or not is another question. I just like to stress that when it gets to the point when you have to invoke the deposit insurance scheme, it's already too late. So that's why all the other steps are so necessary, if not sufficient, to prevent the involvement of the deposit insurance scheme. And in this respect, I also believe that there is no single deposit insurance scheme in the world that can prevent any financial crisis that we are just still experiencing in some countries. And for that reason, some people would like to get to the 100% reserve requirement system, where a central bank would literally confirm any single credit and loan in the country. However, we have to wait there, and then there is a constant trade-off of any central banker between the stability and efficiency. You can have a very stable system, but it's completely inefficient, or rather efficient system, but might in some cases become a problem of stability. For that reason, I believe, and this is something that I would like to relate to what Philip said, I think that the banking union is a necessary step forward also as an answer to the crisis that we are currently experiencing. I doubt that there would be the seriousness of the discussion would be at such a high level today if we didn't experience the latest crisis, because we would all believe that everything was perfect and okay. But it's in financial innovations are just always step ahead from the regulators and central bankers, and this is exactly what we are trying to make and then follow those rules, not to impeding the efficiency and the free flows of capital in this respect.
Good, great. Eric just wants to come in briefly, and then I have a follow-up on this crucial question of the banks.
No, I just wanted, I think you want some drama and some disagreement on the panel, so let me
how could you possibly have got that impression?
Let me offer some, because I think it's very hard to think of a sort of stable financial architecture that does not have a deposit insurance in it. I mean, panics of banks is absolutely an element that we need to try to address. I think the way to do it, and I think this is probably, we agree that at the national level you need to have something, but you also need something at the European level, because we know that bank runs today can have, and we have seen embryos of that, and we have seen in some countries also recently that even very small banks can cause bank runs. So we need deposit insurance also at the European level. I don't think we need a lot, and it can be built up basically through contributions of the private sector, but it's needed.
Great. Now, very importantly, next year there are going to be so-called asset quality tests or stress tests of the banks, looking about what bad loans have they got. And supposedly we've had several of these so-called stress tests, but they've never been really done particularly effectively. And some countries that will remain nameless have been very resistant about having serious stress tests. But they are going to happen next year. Slovenia is the guinea pig. And many people believe that actually some banks may go down, some will be in severe trouble and need to raise more capital. And therefore, some people think that this will be potentially create some volatility in the markets and create a new mini crisis. Is that something that you're worried about from your vantage point, or anybody on the panel?
I think it's more for the bankers, but it's normal that, if we are creating the banking union, we should know what we are buying in. We should know what state of the European banks we have. We've already, as you said, there have been a couple of times we've already been through the stress tests, but they didn't show the real state of affairs with different banks. So it will not help if we are afraid of this. We need to see clearly what is the situation. And I really believe we need strong supervision. We need a single resolution mechanism. we should not be speaking about piling up money to deal with problems, but we should be speaking about system, how to avoid that these problems emerge. And one of the things is, of course, the stress test of all these banks.
Governor, would you like?
I just want to kindly offer, if you need any technical assistance on stress tests and asset quality reviews, we are just currently doing them. So if you need any help in January, you're warmly welcome. And I guess we will learn them by January and then have to repeat them again and again. And for that reason, if there are any offers, we are kindly offering. So
that sounds like an offer I can't refuse from the new kid on the block. The idea of outsourcing the stress test to Slovenia is a very interesting one.
The problem is they have already paid a lot for this, so they want to sell it on.
That's right. There is another, of course, another very important factor, which again, separate from politics, which people are focusing on right now regarding the monetary union, which is the withdrawal of unconventional monetary measures, particularly from the Federal Reserve. And we're already seeing that impact on emerging markets from Indonesia, Brazil, China. Does anybody in the panel worry about this effect of so-called Fed tapering, the withdrawal of the quantitative easing, and how that may affect capital flows in Europe and again lead to a round of volatility? Perhaps Philip Gerson, you might have some interesting thoughts on that, given the Fed is also in Washington alongside the IMF.
Well, thanks very much. I mean, clearly there are some emerging market economies that are already beginning to feel effects from the expectation of tapering. I think our own view is that this volatility is something natural, that countries will need to respond in most cases, by tightening policies. Countries that have flexible exchange rates will be able to use those exchange rates to absorb some of the shock that their economies will face from the eventuality of Fed tightening, and it will be natural to expect some reflow of capital from those economies. In some cases, they'll be facing higher interest rates, and that will have fiscal implications as well. So I don't think that we see this as signs of an impending crisis, but it's clear that as the environment that emerging market economies and that other economies throughout the world are operating in changes, that there'll be policy changes that go along with that as well. But we certainly don't see emerging economies being on a precipice or anything like that from the eventuality of Fed tightening.
Okay. Before we open up for questions from the audience, we just have to spend a few minutes on Greece. Now, Greece has an enormous debt load. Greece has also taken some serious steps to rein in that debt and deal with the public crisis in the public finances. There's been enormous political stress in that country. But so far, it seems to be holding just about together. There's also talk about another rescheduling of the debt, of Greek debt in the next few months. Would anybody on the panel like to assess the record to date of the Greek government and to say whether they believe that Greece is going to remain in the monetary union in the next 3 years, 5 years? Politicians won't want to answer that, but there we are.
Thanks, Lionel. Much appreciated. The first point about the restructuring of the debt, I mean, I don't think we should cross bridges unless it's completely necessary. And we all know that Greece is funding until the summer of 2014. So we'll continue on that track. Second, the Greek situation has not been easy. There's been a lot of political turmoil. They have done very far-reaching, extremely difficult structural changes over the years. We keep on cliche-like saying that there is light at the end of the tunnel, but I firmly believe that there is. So we should allow Greece to continue its structural reforms. We should trust the European Central Bank, the IMF, and the European Commission in their assessment of how those changes are taking place. And at the same time, we should have understanding and sympathy for what is going on in Greece. It's a very difficult situation. They're handling with it. quite well. They're dealing with it quite well. And I'm sure that it's going to be a country back on a growth path. That's what I say as a human being, and I guess consequently also as a politician. I have faith in Greece.
Anybody else like to jump in?
Just to second what Alex said, I think if you look at the record of what's been accomplished in Greece in terms of structural reform, in terms of fiscal consolidation, that there have been dramatic changes there and dramatic policy implementation, and I think it's something that we should continue to support. The Greek authorities have a program that's designed to allow them to prosper within monetary union, and the fund and its partners are doing what we can to help support that. In terms of restructuring, as Alex said, Greece is funded through 2014. We can deal with any issues when that point arrives. The European authorities have made a commitment to help ensure that Greece's debt remains sustainable, and when at a reasonable point, we'll take a look at that commitment and see what else might need to be done to ensure that that commitment is met. And there are many different ways that, many different forms that commitment could be realized. So we'll deal with that issue when the time comes.
Okay. I think it's time to open up to the audience. Please, no statements, political or economic. Lady at the back.
I need your help in trying to help to translate what you've said to the more general public. You all seem so optimistic about the future of the monetary and the banking union, and I can see that from the bank perspective, from the capital owner's perspective, but from where I'm standing, it's not everything so peachy. Why should a common European citizen that doesn't have a lot of money lying around in the banks, which most of us don't, be optimistic, and how will this optimism translate into the everyday life of a common European citizen?
I would say we're guardedly optimistic. We're just not black pessimistic. But who would like to answer that? You look a very optimistic fellow.
Sorry for that. No, it's very easy. Of course, if our economies are growing, then we can create new jobs. And if our banks are healthy and solid, then we don't have to pay your money, our money, my money to save them. So it's really, it will come. First, we need big numbers, and they will turn into small numbers that everyone feels. And the big numbers are here. And that's important. So they were expecting, and they have arrived. So I really expect that sooner rather than later, we will all see this, and we will all feel it. Sorry?
Is it happening?
It is happening. The first stage, the big numbers, it's already happening. And the small numbers will follow, because that's how it works.
You wanted a short and snappy answer. I guess if this crisis was 100 steps, I would argue that we have taken approximately 70 of those steps. I think the times have been very turbulent. There will be a little bit more turbulence, but the worst is over.
Carlos, would you like to say something from Portugal? Because, as I said earlier, you really have been at the sharp end on this for several years.
Absolutely, yeah. I think that the journalist there asked a very fair question about these sometimes dissonance in between the decisions and when do actually people feel it. And one of the things that we have learned with this reform, with this adjustment program in Portugal, is that, first of all, costs to change are always upfront, and the benefits arise with time. And so it's always very difficult for the citizens of any country to understand that they are having these huge costs for something in the future that they don't really know what it is. But that's the definition of the reform, is that I have to do it, and then the benefits will arise. Secondly, you always have this dichotomy in between insiders and outsiders. Any reform you do, and I'm referring to all sorts of reforms, you really have this resistance of the ones that are inside the circle in relation to the others that are outside of the circle. And historically, politicians, governments have actually negotiated with those that are within the circle so they can guarantee their support for reforms that actually benefits the ones that are the insiders and not the outsiders, because the outsiders is the everyday citizen. And let me give you an example. When we did the huge reform on our labor market, that was a market that was basically dual, as Philip was saying, protecting those that have jobs and they have all sorts of protections, to those that are sometimes the youth that don't have any protection because their contracts are actually totally temporary. It's actually difficult to negotiate that you are actually finishing it with something where the insiders will lose and the outsiders don't even know yet what they will win by that reform. And I think what you described was just about that, is the feeling that the everyday citizen has on reforms that will take time. Yesterday, your Prime Minister rightly said, when she spoke yesterday, about the fact that there's no easy solutions, there's no quick fixes. And that's absolutely true. And so the ones and the governments that have had the courage to do those reforms, it's true that people look at us and say, but where are the results? And the results will come on time, but they will come. And we cannot tell to people that they are totally already there, because they're not especially talking about structural reform. So that it's a difficult path, but it's worth it for our countries.
Okay, and I know Eric wants to come in here, but the crucial point is, does all this tough, hard work translate into jobs, employment? Because that's how people tend to measure whether things are working. Eric?
Yes, and I tried to allude to this earlier. I think it is hard to translate what we are talking about into the direct impact on people's lives. But we have tried to get some sense of this by looking at the impact of the crisis on the region where EBRD works, in Central Eastern Europe. That was the part of the world most affected by the crisis. And it's very clear that it's cut very deep into people's lives. You could see the impact on what kind of food they ate and how large their food budgets were. We could see the impact on how likely they were to go to a doctor. So these things are really cutting very, very deep into people's lives. And explaining how what we are doing is going to help that is essential. And what you could see, for example, is that people who had access to a functioning financial system could go to the banks in the crisis. The more you had of that, the less was the impact of the crisis. So what we are trying to create we talk about these big terms of financial architecture and so on, it's really about protecting the depositors that you were talking about, people who put their money in the system. They should know that when they put it in the system, they should get something back. That's what deposit insurance is about. They should know that when hard times hit, they should have access to banks that are willing to engage them and believe that they can weather the crisis. The last very important point is when we look at how did people experience the crisis, how much was the impact on their level of life satisfaction. For most people in Eastern Europe, the crisis that you had in the 90s was a much deeper crisis. So in a way, the impact actually of the crisis, even though it was so deep and it cut so much into people's lives, was actually smaller on life satisfaction in Eastern Europe.